one thing we've been getting a lot of questions on right now is our views on midstream energy as a standalone allocation and how that should sit within a more diversified listed infrastructure allocation. And so we have a couple materials here that we thought would be helpful to kind of explain our thoughts, lay out some key considerations for investors. Obviously, we're also happy to follow up with an individual call if that is in alignment with your goals. And so I think the first consideration that we really wanted to share here was just the very strong performance that midstream energy as a standalone allocation has had over the last 3 years. COVID was very much a 1-2 punch to the overall supply-demand balance as it related to commodities, as it related to crude oil. And in the wake of that, we've had some very strong annualized performance here from the midstream energy sector. Over 40% annualized returns over the trailing 3-year period, dwarfing broad commodities, dwarfing broad equities. And what's happened as you've had that very strong performance has quite simply been a deteriorating investment universe. And so you can see whether in a reduced investable market cap perspective, whether that's in a concentrated number of names perspective, that quite simply the MLP universe has just deteriorated for investors. That same trend would be true even if we include some of the more liquid and diversified C corporations in that analysis. So very strong returns here while the investable universe has deteriorated. And when we think about the prospects for future returns from the midstream energy asset class, understanding that these are potential returns, in general, on a historical record basis, midstream energy has quite simply been propelled by the price of crude oil. Very high correlation over 0.73 over the last 15 years. And so even if you believe that commodity prices have the potential to be more sustained when looking ahead due to more favorable supply-demand dynamics, the prospects for future midstream outperformance at the scale that we saw over the last 3 years seems more limited in our view. I think you really need the commodity price momentum in order to ignite that sort of outperformance. We think that midstream energy has a place in investor portfolios, but that place is very much within a diversified and durable listed infrastructure allocation. And so when we think about listed infrastructure more broadly, we see active managers as having the ability to toggle their midstream weight up and down when warranted, but certainly to offer access to some more durable investment thematics. And so when you think about global utilities as an example, some of the leaders in terms of developing renewable power, some of the largest owners and operators of transmission grids, those long-term thematics very much more aligned with long-term energy demand trends. You further have the contributions in listed infrastructure from companies like cell towers, from companies like data centers, beneficiaries of either the AI thematic or of increased data demand more broadly. And then you also have within the transport sector some very prized assets that enhance upside capture during periods of economic growth while offering some wonderful inflation capture mechanisms. And in particular, I'm thinking of some of the large toll roads within listed infrastructure on a global basis. So a more diversified and durable listed infrastructure investment universe. When you think about the historical record, listed infrastructure has very much outperformed on a risk-adjusted return basis. We think that's in part due to that more diversified and durable universe built on a bedrock of contracted and regulated returns. And you can see here on the left-hand side what listed infrastructure has done in terms of total return, in terms of total risk. And you can compare that to what MLPs, natural resources, or global equities have done. That historical record is at a more compelling valuation at this point in time. And so if you think about what midstream energy has done on a multiple basis relative to listed infrastructure, you're in a situation today where listed infrastructure has significantly derated over the last 3 years, as a lot of that midstream price performance has just been aided by, I think, that correlation to crude oil price momentum. When we look ahead, I think one thing to consider is the comparative yield plus growth potential, a total return proposition, if you will, between listed infrastructure and midstream energy on a standalone basis. And so with listed infrastructure, what you see is a 4% dividend yield. This is kind of near historic highs at this point in time, and some very strong income growth when looking ahead, built on a lot of those secular investment thematics on those regulated and contracted returns. Within midstream energy, on a standalone basis, you're getting a higher upfront yield, but you're getting much lower growth in the long term. And I would also add that that upfront yield is lower if you're looking at the more investable USC corporations, as opposed to midstream energy just in the MLPs alone. And so a superior total return proposition in our view in listed infrastructure, validated, I think, by some of the privatization activity that we've seen over the last 2 years. So if you look at privatizations for midstream compared to listed infrastructure more broadly over the last 2 years, the private markets are paying much higher premiums for data center assets, for cell tower assets, for regulated utility assets and prize transport assets than they are for, say, long-haul natural gas pipelines or gathering and processing assets. And so just, I think, the private market here kind of validating the view that in listed infrastructure more broadly, perhaps the potential for stronger total returns. And then just the last consideration that I wanted to leave you with here was really the potential for manager outperformance. I think this is very much symptomatic here of the declining investment universe that midstream managers have had to face over the last decade. Quite simply, some of the biggest and the best companies are also the largest weights in major midstream energy indices. They're the ones with the advantages of scale. They're the ones with the stronger balance sheets, the stronger growth proposition over the long term. And so you're effectively forced to invest in those names with decreasing overall outperformance relative to your index as a result. And you can see that this is true for midstream or MLPs, either on a rolling 5-year basis or on a standalone trailing basis. And I would compare that towards listed infrastructure, where the outperformance has been much more durable. Again, listed infrastructure, a niche asset class to be sure, but one with an enhanced investment universe in our view. And one of the things, as I've spoken about before, that we do at CBRE is manage that broader, more comprehensive investment universe, $4 trillion of addressable market cap. We feel that that has certainly aided our own strategy returns in outperforming major infrastructure benchmarks, as well as peers with lower overall volatility over the course of time. And so just a few key considerations there between midstream energy and listed infrastructure. We think a very opportune moment for investors to supplant those standalone allocations with listed infrastructure more broadly. If we can be helpful as a resource for you, either in your coverage of MLPs or midstream or of listed infrastructure or real assets more broadly, please do let us know. I look forward to speaking with you in the future. Thank you.